The term turnover means total amount of goods or services sold by a business during a particular period of time. It includes cash realized from debtors, cash payment to creditors, etc. Turnover ratio is one of the important ratio of accounting ratio which is calculated to analyze the financial statements and their interpretation. Turnover ratio measures the efficiency or effectiveness with which a firm manages its resources or assets. These ratios are called turnover ratio because they indicate the speed with which assets are converted into sales and cash. Funds are invested in various assets in a business to make sales and earn profit. How efficiently these assets have been used or managed by the business is measured with the help of turnover or activity ratio. So this is the efficiency or effectiveness, that the turnover ratio indicates the efficiency or effectiveness of the management, how efficiently these assets have been managed by the business, and that is reflected by the turnover ratio. Like debtors turnover ratio and a stock turnover, that is, this ratio indicates the rate at which inventory of finished goods are converted into revenue from operation. That is, it also a main measure of liquidity. It determines how many times inventory is purchased or replaced during the year. The higher the ratio, better it is for the business, since it means that inventory is being sold quickly. It determines how many times inventory is purchased or replaced during the year. There are number of ratios we calculate turnover ratios. These are among them the importance. Inventory turnover ratios we calculate trade receivable or debtors turnover ratio, average collection period, trade payables, creditors turnover ratio, average payment period. These are the important turnover ratios we need to calculate from the financial statement. We will learn one by one each turnover ratio and what are the different formula. So let us understand about the inventory turnover ratio and how it is calculated, these turnover ratios. So inventory turnover ratio or a stock turnover ratio, this ratio establishes the relationship between cost of goods sold or cost of revenue from operation and average value of inventory or a stock. So this ratio is calculated using this inventory turnover ratio formula is cost of revenue from operation divided by average stock. And the term cost of revenue from operation means the goods which is sold, what is its cost price, that is cost of revenue, the cost price of the goods that is sold, and the sales price is the revenue from operation. This is called revenue from operation. Cost price is cost of revenue from operation, and the same goods sold at making certain amount of profit, so then it is revenue from operation. That is, the cost price of the goods is 100 and it is sold at rupees 120, then the 120 rupees is revenue from operation and 100 rupees is cost of revenue from operation. And average stock formula, opening stock plus closing stock divided by 2, this is the average stock formula. Okay, based on this formula we need to understand about the stock turnover ratio. Here the cost of revenue from operation, this is how it is calculated. That is here. Revenue from operation means sales minus gross profit. If the gross loss is there, then revenue from operation, sales plus gross loss. And alternatively, the cost of revenue from operations can be calculated using this formula also. Here, cost of revenue from operation equal opening stock plus purchase plus direct expenses minus closing stock. So here the term sales, this one sales, this is this one sales revenue from operation, or cost of goods sold is revenue, cost of revenue from operation. So alternatively we can use this term cost of goods sold or cost of revenue from operation, and sales or revenue from operation. So based on this formula, let us solve one numerical problem from the stock turnover ratio. Let's see, very simple problems here. I am going to explain you, all of you watch it very carefully. So this is the stock calculation of the stock turnover ratio from the following data. So cost of revenue from operation is rupees 1 lakh, and average stock is given 20,000. Directly it is given opening stock plus closing stock divided by 2. The final figure is given here. So then using these two components, let us calculate the stock inventory turnover ratio or stock turnover ratio. This is this one. So formula is here, cost of revenue from operation divided by average stock. So cost of revenue from operation is your 1 lakh and average stock is given 20,000. So here 5 times. So answer is 5 times. So it indicates that the stock rate at which inventory of finished goods are converted into revenue. So 5 times. It is also measure liquidity, determine how many times inventory is purchased or replaced during the year. So during the year 5 times inventory is purchased or replaced. Another illustration, calculate a stock turnover ratio from the following data. Revenue from operation is 1,50,000, gross profit 30,000, opening stock 30,000 and closing stock 50,000. Using the above formula, cost of revenue from operation by average stock, and the revenue from operation is 1,50,000, gross profit is included 30,000. So that means the 1,50,000 minus 30,000, 1,20,000 is cost of revenue from operation, and it is calculated as under here, this one. Cost of revenue from operation is 1,50,000 minus gross profit, it is given in the question. This is 1,20,000 is cost of revenue from operation, and revenue from operation is 1,50,000. So an average stock we have to calculate, opening stock plus closing stock by 2, and given opening stock and closing stock is given in the question. So 30,000 plus 50,000, 80,000 and 40,000 is average stock, and putting this value in formula, then we will get finally the stock turnover ratio in here. This is therefore the stock turnover ratio is how many times? It is 3 times. So in a year a stock is converted into sales or purchase 3 times during the year. Okay students, so all of you watch it, like and subscribe, and don't forget to keep comments and share with your friends. Thank you very much.